If you're looking for an ETF that pays you now and helps you grow your money for the future, SCHD might be the one ETF you never realized you needed. For over a decade, this fund has quietly delivered rising income, low fees, and rock-solid stability, even during tough markets. But what makes SCHD different from the rest, and is it still worth holding in 2025 and beyond? In this video, we're breaking down how SCHD really works, what's inside it, and how it compares to other popular dividend funds. And the results might surprise you. Stick with me, because by the end, you'll not only understand how SCHD keeps building wealth year after year, you'll also know exactly what to watch for going forward. This isn't hype, it's real data, proven performance, and a strategy built for smart, long-term investors. Let's dive in. SCHD, quiet power behind consistent income. While many talk about building income, SCHD has actually done it year after year. With more than 3.6% in returns, consistent increases for over 10 years, and a basket of dependable US firms, SCHD's earned its place among the top dividend funds. In the first 3 months of this year, it distributed 66 cents per share. That's a 13.8% boost compared to the same quarter the year before. And no, this isn't just a one-time jump. SCHD has steadily raised its payouts for over a decade. What's behind that climb? And is it really a wise choice for those who care about earning steady cash? SCHD, short for Schwab U.S. Dividend Equity ETF, follows solid American businesses with strong balance sheets and long-standing habits of rewarding shareholders. But SCHD isn't just about steady paychecks. It's also built to grow, and that mix of income and expansion is what sets it apart. Chapter 1. A look at SCHD's dividend growth journey. Let's break it down with real numbers. In 2012, SCHD handed out just 63 cents per share for the full year. Fast forward to 2023, that yearly total rose to $2.48. That's almost 4 times more in just over 10 years. And it's not up and down, it's consistently upward. On average, SCHD has pushed out around 12.5% annual dividend growth thanks to smart company picks and the magic of compounding. That kind of progress is impressive, especially for an ETF. Let's zoom in on recent numbers. In 2022, SCHD gave out $2.36 in dividends. In 2023, it climbed to $2.48. It's not a massive jump, but it's still a step forward, showing the payout trend is alive and well. Now, here's the real standout, the latest update. In the first quarter of 2024, SCHD handed out 66 cents per share. That's a 13.8% jump from the 58 cents in quarter 1 of 2023. And this comes right after a record-breaking quarter. In late 23, SCHD delivered 71 cents per share, the highest single-quarter dividend in its history. This momentum isn't slowing, it's gaining speed. Now, let's talk about dependability. SCHD has never reduced its dividend even during tough times. Think back to 2020, when the world shut down. Many companies cut back, but not SCHD. It actually went from $1.98 in 2019 to $2.09 in 2020. That's the kind of stability most funds can't offer. And the growth isn't just from more buyers, it's from companies within the fund increasing what they pay out per share. That means the rise is genuine, repeatable, and driven by strong business results. This is why so many income-focused investors stick with SCHD. Not just for the payouts, but because those payouts keep rising. Chapter 2. What's inside SCHD and why it works. Now, you might ask, how does SCHD keep increasing payouts year after year? It all comes down to what's inside the fund and how it selects those companies. SCHD follows the Dow Jones US Dividend 100 Index, but don't be fooled. It doesn't just grab the top-paying stocks. Instead, it uses strict filters based on quality. First rule, a company must have at least 10 years of steady dividend payouts. That knocks out the risky and unpredictable ones. Then, SCHD looks at 4 major signals. Profitability, measured by return on equity, how much it pays shareholders, dividend yield, its ability to handle debt, cash flow versus liabilities, and how fast its payouts have grown over the last 5 years. This creates a powerful combination. SCHD doesn't go after just high yielders, it targets firms that are financially stable, generate consistent profits, and can increase payouts reliably. Today, the fund holds around 100 companies, all from the US. But here's what stands out. Over 70% of the portfolio is focused in just 3 areas: industry, finance, and healthcare. That's intentional. These sectors are full of companies that are built to last and keep sharing profits, even when the market struggles. Some top positions include Coca-Cola, Merck, PepsiCo, Broadcom, and Texas Instruments. These aren't wild growth tech names, they're strong, steady, and proven performers. Also, SCHD limits risk by capping each stock at no more than 4% of the total portfolio whenever it rebalances. That means, even with a focused approach, it stays well diversified. So if you look closely at what SCHD owns, the strategy becomes clear. It's not gambling on hype, it's built for reliable growing income, backed by real business strength. Chapter 3. How SCHD measures up to the competition. That steady selection process is a huge part of why SCHD keeps increasing payouts year after year. But let's zoom out. How does SCHD compare to other top dividend ETFs? First up, we have VYM. That's Vanguard's High Dividend Yield Fund. It's extremely popular and holds over 400 companies, so it's spread out wider than SCHD. But when it comes to dividend growth, VYM does not keep pace. Over the last 5 years, VYM has raised its payouts by around 7% a year. SCHD, on the other hand, grew its dividends by roughly 12% annually, a clear difference. Next, we have DVY from iShares. This one leans heavily on high-yield stocks, especially from the utility sector. But that comes with trade-offs, slower growth, and in some years no growth at all. It's also more volatile, with wider swings in returns. Now let's look at NOBL, the Dividend Aristocrats ETF. It only includes companies that have boosted dividends for 25 years in a row. Sounds impressive, right? But here's the downside. Its yield is smaller, and it focuses mostly on companies inside the S&P 500, which means more weight in consumer staples and industrials. So where does SCHD really shine? Simple. It balances solid income with strong growth. It doesn't just reward history, it looks for financial strength and future potential. And to top it off, SCHD keeps costs incredibly low, with an expense ratio of just 0.06%. That's among the lowest in the dividend ETF world. Chapter 4. What SCHD offers to smart investors. While other dividend funds have their own advantages, SCHD delivers something special. It's tight in design, sharp in focus, and provides rising income without taking on too much danger. So, what should you take away from all of this? First, SCHD isn't only for older investors. Sure, it pays reliable dividends, but because those payouts keep growing, it's also great for young investors looking to grow their money over time. If you choose to reinvest those payouts, the power of compounding can really take off, especially when the fund increases what it pays year after year, like SCHD has been doing. Second, it's easy to manage. No need to research dozens of companies, no checking earnings, no stressing over whether a dividend will be cut. SCHD is a buy it, leave it, and let it work kind of fund. You invest once and the strategy handles the rest. Third, it's cost effective. With just a 0.06% expense ratio, you keep more of your returns. That savings grows more meaningful the longer you stay invested, whether that's 10, 20 or 30 years. Fourth, it offers both income and growth. Few funds combine steady cash payouts with long-term performance like SCHD does. Still, no fund is perfect. SCHD leans into certain parts of the market, and it only includes US companies. If you're aiming for global reach or more tech exposure, you might consider pairing it with another fund. But when it comes to a dependable dividend-focused core holding, SCHD covers almost everything investors look for, and that's why it keeps earning a spot in smart portfolios year after year. Chapter 5. Final thoughts. What to watch next? Let's wrap this up. SCHD has shown it's a standout performer in the world of dividend-focused ETFs. It delivers a healthy payout, keeps increasing those returns year after year, and does it all while maintaining low expenses and choosing high-quality companies. Compared to other funds, SCHD finds that rare middle ground, providing cash flow today while still offering growth potential for the future. But looking forward, there are a few key things to monitor. If the rules of the index change, it could shift which stocks SCHD invests in. Also watch how dividends behave in key industries, especially in banking and healthcare, which are large parts of the fund. And yes, interest rate moves can still change how attractive dividend strategies feel to investors. But if SCHD continues to follow its disciplined system, it's likely to keep producing exactly what long-term investors need: trusted companies, rising income, and a strategy built to create real wealth over time. Thanks for staying till the end. If this video gave you value, hit like and consider subscribing for more simple fact-backed investing guides. I'll catch you in the next one. Here's to your investing success. Profitable investing.